Good morning, everyone. This is Chris Verrone, Head of Technical and Macro Research here at Strategas, the investment strategy arm of Baird. It's a pleasure to be with you again. A lot going on in the world. There are four things I want to touch on in today's video. Number one, we'll discuss the conditions we're looking for to feel more confident that a market low is in place. Secondly, I want to talk about the leadership fabric of this market and really how consistent it's been. Third, we'll take a look at sentiment and what messages we're seeing there. And then lastly, I want to highlight just a couple of macro charts that I really think are driving the thematic and bigger picture call. But where we begin this morning is really what's been prevalent in our work for the last several months, talking about what it takes historically to resurrect a trend or to revive a bull market. And the one thing we've just seen time and time again, when you're coming off of a low, what you're really looking for is unmistakable momentum, that get me in at any price, urgent attitude that you see coming off these correction lows. And how we're measuring that here is the percent of stocks with a 2 standard deviation daily advance. When you're coming off a low, you want to see a surge in this data, 50, 60, 70% of the market with a 2 sigma daily move. I think the unfortunate news is we've yet to see that on any of these rally attempts. So as the market tries to stabilize in this 41, 4,200 S&P zone, something I think we'll need to see to feel more confident that a low is in is a momentum surge going forward. We'll continue to watch for it. We haven't seen it yet. I would also just note historically, we've done a lot of work on this midterm election cycle. February, March, April historically would be early in the calendar year to put in your cycle low. This is every midterm election year low back to 1950. The average is roughly August. So again, it's late April, it's early in the calendar to be thinking about your midterm cycle low. As far as the leadership framework of this market goes, the thing we really continue to hone on and talk a lot about is owning the average stock versus the top of the market. And that's really what we're showing you here. This is the S&P excluding the tech and communication sector relative to the NASDAQ 100. So there's a big turn going on here. That is the average stock, the non-tech issue, really starting to outperform. That's where we think we continue to find leadership. This is evidenced in strength from energy and basic resources, the insurance names, the pharmas, the REITs, the utilities. That really makes up the bulk of leadership here in our work right now. Where we're not seeing leadership is clearly tech, and I just want to make sure that everyone's aware. Tech has now surrendered all of its post-COVID alpha. So tech relative to the S&P has given back about 2 years of leadership. I recognize some of these names may be oversold and can be bouncing here, but those are generally rallies we want to be skeptical of. This is not a leadership group here anymore. Now, in terms of sentiment, we've gotten a lot of questions from clients over the last several weeks about what we make of the AAII survey. It's a survey of retail investors. It shows the fewest number of bulls since about 1992, so a 30-year low in the number of bulls. So there's clearly a lot of pessimism out there. And frankly, this indicator has a fairly good track record in producing some decent forward market returns, so it's a contrarian indicator. The problem I have with this right now in really giving it maybe the respect we have at other moments is that the other sentiment indicators are not sending the same message yet. And in particular, I would point your attention to the put call data. One thing we always look for at a market low is a sign of capitulation or a capitulative attitude, anxiety in the options market, and we measure that through put call ratios. We've yet to see what I would describe as an extreme reading here. We're looking for 99th percentile readings in put volume. We have that neither in the daily reading or in the 10-day average of the series. So yes, I recognize some of the survey data is looking pretty stressed here. It has a decent track record. I would feel better about making a contrarian sentiment call if we saw the put call data reflect a similar outcome. I don't think we're quite there yet. And when we go back to leadership, this market is really about as split as we can remember. We call this our sector matrix. Essentially, you want to be owning the groups that are on the right side of the ledger here. That's REITs and UTs and energy and some staples. And you want to be more skeptical of the groups on the left side of the ledger. It's tech, it's discretionary, it's communications. We find materials, healthcare, and financials kind of in the middle here. I think there's some good groups and some weak groups in those sectors. But largely, we use this framework to identify where the best trends in the market are. Speaking of consumer staples, I want to show you one or two last charts here. This is a relationship we look at to gauge what the market's perception of the consumer is. This is consumer discretionary relative to consumer staples. We always equally weight this, so this is not Amazon versus Procter & Gamble. This is what is the average consumer name doing relative to the average consumer staple. This was one of the indicators that I really think allowed us to be as bullish as we needed to be coming off the March, April, May 2020 lows. So I need to give it the equal respect here. This has continued to weaken over the last several weeks. This made new relative lows this week, in fact. So we'll continue to look at discretionary versus staples. It's one of those risk-on barometers that is frankly still sending a pretty risk-averse message in our work. When I look at the macro, just to conclude, I think there are two big stories. The first we show you here are 10-year yields. We are bumping right up against a 40-year downtrend in yields. At a minimum, I would expect some battle to be fought here. I don't think the bond bulls are going to give up without a fight. It's our sense this, call it 275 to 325 zone is, at least in the interim, is going to be a difficult area for bond yields to punch through, particularly with counter-cyclical leadership. Utilities outperforming banks is not a message that screams higher yields, and we're right at resistance here in tens. And then lastly, when we look to the currency market, what is going on in Japanese yen right now is absolutely remarkable. I think there are some shades of breaking the Bank of England from September of '92 here. We've had about a 15% drawdown in Japanese yen versus US dollar over the last couple of weeks. A very, very startling move in currency markets. I think it speaks to the idea that the Bank of Japan will not be successful in keeping a lid on 10-year JGB yields, and the outlet for that thus far has been weakness in Japanese yen. So that's what we have today. As always, I appreciate you joining us. When I look at the market here, I think the big takeaway from us is if we're going to come off this low, we need to see momentum. And then I think, secondly, watch that put call data. If we're getting closer to a capitulative moment that should start to signal. We haven't seen it yet, but we'll be on the lookout and we'll keep you updated as the facts change. Thanks again. Talk to you soon.